Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Well, a significant story that we're following today, of course, is the U.S. Supreme Court preserved full access to a widely used abortion pill in a case that carried major stakes for reproductive rights and election year results. The court unanimously overturned a federal appeals that would have barred mail-order prescriptions of mifepristone, the drug now used in more than half of U.S. abortions. Let's get some color on that. We do that with Wendy Schiller. Wendy is the professor at Brown University. Wendy, what do you make of this decision coming out of this Supreme Court here in what is an election year?
Yeah, hi, Paul. I mean, it's an interesting decision. They really use the idea of standing. They basically said, you know, the people who are suing are not injured directly impacted by this, by the FDA's power to approve this called abortion pill, but that's the moniker for it. And so they really stuck to jurisdiction. Like, you don't have standing to bring this case to us. The Fifth Circuit, said upheld the plaintiff's request, but also in their opinion said, well, we're not sure this is going to hold up at the Supreme Court. None of the plaintiffs are directly injured. And that's the way the Supreme Court unanimously got out of sort of the bigger debate about this pill and abortion. It is used in the majority of medical abortions in this country. So the politics are that the Republicans can breathe a sigh of relief because the Democrats cannot make this another issue on top of abortion access. But on the other hand, pro-life groups will now push Republicans on the campaign trail to say they'll do something legislatively about this rather than through the courts.
What could they do legislatively then? What would be on the docket for that?
Well, Alex, they could do a few different things. One is they could limit the jurisdiction of the FDA. They could, try to reverse the supremacy clause, which is that the federal law supersedes state law. Louisiana, for example, has now scheduled this particular pill as a dangerous substance, which really limits its access. That's going to happen in more states. The question is, can the federal government undo that or contradict that? So they could push for laws that say in this particular case, the FDA overreaches and Congress is not giving the FDA this power. I think it's unlikely that the Congress will do that for lots of reasons having to do with drug development and access, but it could be something that some Republicans bring up on the campaign trail, but it will only sort of fire up people who are really concerned about abortion access, who showed their electoral might in 2022 and are expected to get out the door again in 24.
So I guess, Wendy, how do you think each campaign will maybe approach this issue here? I mean, are they just going to say, the Supreme Court is ruling, will continue to rule, and will abide by that? I mean, how is this ruling today, do you think, will impact 24?
Well, Paul and Alex, I think the Biden administration will take credit for having an FDA, and some of these decisions predate the Biden administration, but protecting the FDA's discretion and FDA as a medical institution. And they'll say, listen, if you want to make sure that your access not just to this drug, but to lots of other drugs that might help you or save your life, you have to go with us because we're the ones who believe in science. That will be the Biden message. Trump will be quiet about this. He has tried to back away from abortion, really saying leaving it to the states rather than going for some national ban, because he recognizes that of all the issues that could deny him a victory, abortion is very high on the list, especially in states like at least Arizona for now, and possibly also on the ballot in Florida.
So there is another abortion case before the Supreme Court. Can you walk us through what that is and how it differs?
Well, I mean, the other thing is about whether emergency room doctors and hospitals have to provide abortion to save the life of somebody. In other words, to make the case that even in a state that doesn't allow abortion in case of danger to the life of the mother, that they, in fact, are obligated to and have to do this and won't be put in prison or, sued for doing it. So this is a really big case. because we've already seen where doctors have become more hesitant in states like Texas for really taking this step in order to save the life of a mother for fear of prosecution or losing your medical license, for example. So this is a bigger case for the actual surgical procedures of abortion.
So I guess, as you think about it, just in the context of a presidential election year, Wendy, what do you think? Are members of Congress, are they bringing this to the forefront, or they just don't want to get anywhere near this issue in what is an election year?
Well, Democrats want to basically advertise in most, but not all states, that they are the party that will try to protect access to reproductive health care, particularly in cases of rape, incest, life of the mother, but also that they are the party that will not come after contraception, for example. The Republican members of Congress, with some exceptions, want to really stay away from this issue. They really believe that this is the one issue that could cost them congressional races and the presidency, just based on what we saw in 2022 in response to the Dobbs decision. So Republicans want to stay away from it. They're hoping the court doesn't give the other side a lot of ammunition. And the Democrats are really going to hit home with this message, particularly in those two swing states that I mentioned, Arizona and Florida.
So considering that the case that we found out about today was a procedural issue, and that's why the vote went the way it went, what are going to be the two sides in the Idaho case?
Well, this is really, it will come back to the court's position that abortion is a state's issue, that states have the right to regulate all conditions and access for abortion. That's pretty much what Dobbs did. And now Trump has reiterated that he believes it's up to the states. So if states want to criminalize giving a woman an abortion, even to save her life, I'm not sure the Supreme Court's going to step in and say, no. They've already, basically said it's up to the states. So I think that's the big question mark. And politically for the Republicans, this is a very difficult issue. If it in fact becomes the case that doctors are threatened with prison for saving the life of a woman, that affects women everywhere. It affects women and their daughters. It affects a lot of people in their daily life in terms of their reproductive health. People who are trying to get pregnant, people who have a complicated pregnancy. So it really gets to that core of voters that rejected the Republicans in 2022 on this issue and are very likely to do so again if it is the case that a state, can really prevent a doctor from saving a woman's life.
So are we going to end up, Wendy, with abortion policies that really are red and blue? Are we going to have that checkerboard in this country? Is that kind of how this thing may develop?
I mean, you can argue, Paul, that we already have that. And we certainly had a little bit of that before abortion was legalized in 1973 with the court decision. And we really, when you think about it, there are states where it's really almost virtually impossible to get an abortion. And certainly with a 6-week abortion ban, that becomes very difficult because a lot of women don't know they're pregnant by then. We really have a situation where there is a slight majority of states where abortion is still accessible. And then we have a great number of states, more than 20, where it's very difficult for a woman to get an abortion, and sometimes even in the case of rape, incest, or life of the mother. Now, Texas argues that's not their law, that people are misinterpreting it, that in fact, that doctors can perform this in Texas and not be penalized and not be criminalized. But the perception is out there that you can, in fact, bring this kind of charge, or even a civilian can bring a charge against you for it. So it's really deterring women's seeking of abortion in those states. Now, some other opponents will point out the fact that we actually had a slight increase in the overall number of abortions last year. And that's where access to this pill makes a huge difference for many women in America in terms of securing an abortion.
Interesting. Okay, that actually really helps to highlight that even though it may be difficult, that's why this pill became so important. Wendy, really amazing stuff. Definitely looking forward to having you back. Wendy Schiller, professor at Brown University there, standing by. But nonetheless, definitely sets the stage for the November election and sort of the policies that will come after that, which to me then begs the question, as an investor, bringing it back to our home base, what do you do about this? Yeah. And clearly investors are very worried about immigration. I mean, investors, voters everywhere. Yeah. Sure. Very worried about immigration and very worried about fiscal policy. France has made that clear. The UK has made that clear. India made that clear. Mexico made that clear. What do we do with that now? If we look forward to the US in November, because no one's going to be tackling fiscal policy.
No, I mean
the deficit. No way.
I mean, deficits continue to run rampant. The national debt continues to balloon as a percentage of GDP, and but quite frankly, I've been around a while. This is always always been an issue, and no one has had the political or economic courage to try to tackle it. So I'm not sure what changes.
And it's always the whole it matters when it matters and doesn't matter. I mean, at the end of the day, that's what it comes down to.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news and analysis with our Bloomberg analysts. They cover 2,000 companies in 130 industries worldwide. And then sometimes we take you outside Bloomberg Intelligence for the view on the street. Today we go to Kristina Hooper, Chief Global Markets Strategist over at Invesco. She joins us now. Kristina, I got to say I'm bored now. We got through CPI and we got through the Fed. Okay, bonds are still getting a bid, so I put out there that we could see some significant levels now, lower in yields. What do you make of the market? What are we going to be looking at next?
So I think next up on the docket is going to be Friday's inflation expectations from the University of Michigan. Now, it might not seem that important, but to central bankers, consumer inflation expectations are important. It's part of the calculus. If we go back to June of 2022, you may recall the Fed messaged in advance of that meeting that it was only going to hike 50 basis points, then turned around and hiked 75 basis points. And when asked about it at the press conference, Jay Powell pointed to a few different data points, including Michigan inflation expectations. So I think it's important. But I also am confident that it's going to show that inflation expectations are pretty well anchored. And it will be part of the mosaic of data that the Fed reviews next time, and which I think will cause the Fed to begin cutting in the third quarter.
Cutting in the third quarter. Okay. So I know, at this time of year, Kristina, every 6 months, you folks at Invesco, you bring together some of your key investment professionals, thought leaders, and think about the next 6 months. What's the next 6 months look to you guys?
So in terms of the economy, we expect to continue to see a slowdown in the U.S., a cooling, but we would anticipate that that's going to be relatively brief and that by the end of the year, we'll see a reacceleration in growth. There'll be catalysts like the start of rate cuts, as well as improvements in real income. That will help consumers. Mm-hmm. So all in all, a better picture economically by the end of the year, but nothing bad in between. And we would anticipate markets starting to discount that soon. So that would mean a broadening of the stock market, more participation, better performance from cyclicals and smaller caps, and in a more sustained way once we start to see the rate cuts begin from the Fed.
Kristina, but once you see that growth and the cuts, does that lead to higher inflation then?
No, I think that the Fed has done a very good job putting out the flames of higher inflation. So I don't think the risk is as big as they suggested yesterday, that there could be some kind of resurgence in inflation. And we certainly don't have the kind of fiscal stimulus we had that I think was an important part of why we saw such a big increase in inflation. I just don't see that happening going forward.
How about in Europe, Kristina? Last couple of days we've seen some changes in the EU. We've seen in France snap elections. We now have the France-Germany 10-year yield gap set for the widest since 2017.
Look at you!
Look at me going.
BTP Bund spread.
Exactly.
All right.
All geopolitical. How do you think about the European zone? Because there seems to be some unsteadiness there.
Well, we try to put blinders on when it comes to politics because it can cause volatility in the short term, but beyond that tends not to have a significant impact on markets. So when I look at Europe, what I see is positive economic surprise. And I see the potential for more of that going forward. We also, when we look at European equities and UK equities, what we see is greater exposure to cyclicals. So they'd be more sensitive and potentially benefit from an economic reacceleration. And I also see an increase in stock buybacks coming in both those markets. So there's a lot to be very positive about when we look at Europe and the UK.
How can you put blinders on when it comes to politics, in that we've seen a lot of violent shocks in the market, whether it's France or Mexico or South Africa or India, and the market reaction is what seems to be catching investors on the back foot. Are we learning a market reaction function to the election in November?
Well, I think there's certainly the possibility that we have a significant market reaction in the short term. We have seen that absolutely with Mexico, with India, and there's certainly the potential for it to happen again. But most investors have a longer time horizon than 2 weeks or a month or 2 months. And so that's why I would argue it's important to put blinders on when it comes to things like politics.
All right, so if we want to stay close to home, U.S. equities here, do I just stay with the big cap growth names that have worked so well for so long, or do I try to get a little bit more bold here, take a little more risk, and try to find some value out there?
I think you need to be well diversified. And for most investors, their portfolios are likely overweight the large caps, the growths. So it's time to rebalance and ensure there's adequate exposure to smaller caps, to value, to cyclicals. I think those areas will perform better as we start to discount a reacceleration in the economy. That doesn't mean that the big cap tech names are going to do terribly. It just means that participation is going to broaden and we could actually see outperformance by the cyclicals.
Is that so diversified? So that, and I know you mentioned cyclicals over in Europe as well. Is it do you need to sell tech to buy the cyclicals, or do you just need to sort of take from cash? What do you think?
I think what's more likely the case is that there is an overweight to cash in investors' portfolios, and especially as the Fed begins to cut rates and cash isn't paying as much, there's a greater argument for reshuffling and at least allocating some of that overweight to cash to cyclicals. But in some cases, there could be extreme overweights in portfolios to technology and large cap growth, and it also makes sense to rebalance there as well.
How about alternative investments? We have private. We all grew up with private equity, hedge funds. Now there's private credit. It seems like there's a lot of opportunities to allocate capital to alternative investments. How do you guys at Invesco think about that?
We think that makes a lot of sense. We were one of the earliest proponents of including alternatives in portfolios. Still believe that's prudent for many investors' portfolios, that greater diversification, lower correlations, it all makes sense. And there are certainly many opportunities we're seeing in areas like private credit. And I would actually argue there are opportunities appearing in real estate as well.
Ooh, where?
Well, we're certainly seeing European real estate has bottomed. And I also believe there are some opportunities in U.S. real estate that will appear as the year progresses. Keep in mind that one important tailwind, again, will be rate cuts.
So given what we saw, Kristina, yesterday from the Federal Reserve, what we heard from the Federal Reserve, what's penciled in as your base case here? I know a lot of folks are trying to get a sense of, do we have something in December? Do we have something maybe even a little bit sooner? But oh boy, we have this election. How do you guys think about it?
Well, we hate to have false precision, but I do think we believe the most likely scenario is 2 rate cuts this year. And obviously, the Fed is very data dependent, so that can change. But based on what we've seen in terms of disinflationary progress, and given what the Fed told us yesterday, which is that they anticipate 1 rate cut without any progress on disinflation. Keep in mind their core PCE target, their forecast for the end of this year is where core PCE is today. So I would argue that means that no progress equals 1 rate cut, then some progress in disinflation, which seems increasingly likely, could mean 2 rate cuts. I'm a believer in that. So I would argue the most likely scenario is September, December. I don't think the election is going to change the Fed's timeline. They've been clear about that.
Kristina, really, really interesting conversation. I learned a ton. Kristina Hooper, Chief Global Market Strategist over at Invesco. And that's the jewel, right? You get growth,
Yep.
You get cuts, and you have inflation coming down. And that leads to your cyclical bias at the end of the day.
That seems constructive. Right,
that seems
for
like the
risk
best
bets.
case scenario.
Seems
Yeah,
like
absolutely.
a pretty darn good scenario.
Bank of America also saying that the pain trade in the second half could also be led by cyclicals because kind of no one's investing in them because they're all in tech and overweight tech at the same time. We didn't get to talk about bonds, but we will in the next hour. You're looking at the 10-year down by another 3 basis points. We're at 4.283. That's where we are for the 10-year. Also, that 2-year coming down as well to 4.7% as, let's be honest, equity market's not doing much.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence Radio. We bring you all the news in business and finance and economics through a lens of Bloomberg Intelligence analysts. They cover 2,000 companies in 130 industries around the world. And we go to one of them now, Salih Yilmaz. He's Senior Energy Analyst at Bloomberg Intelligence. He joins us from Dubai because something that's been really confusing for like seasoned oil watchers is what is happening with the oil price. You got Brent sitting at $82.88 a barrel. If you try and understand what OPEC Plus is doing of like what the quotas are for what countries when they're adding oil back, it is 3 times more complicated than the dot plot. I'm not at all kidding you. Salih, do you agree with me? I mean, it's so confusing as to understand what OPEC Plus is doing that I don't blame the oil price for being confusing either.
No, I totally agree. I think the current outlook for the oil market and oil prices is that we do have abundant supply for now, and the demand picture is still quite bleak, especially for the second half of this year. And when you look at what OPEC Plus is trying to do, I mean, they currently have 3 layers of output cuts, and this is pretty confusing for OPEC watchers like myself as well. And what they told the market at their last meeting on June the 3rd was that the first 2 layers, they are holding on to those cuts until the end of last year. But the 3rd layer, which was just voluntary output cuts by only 8 member nations from OPEC Plus, they will extend them until the end of the 3rd quarter, but starting in the 4th quarter, they will start to unwind them. And the market actually didn't like this at all, which tells me, once again, that what the market is seeing is plenty of supply, even in the 4th quarter of this year, and the demand outlook that's still pretty soft. I mean, I don't think demand has necessarily been bad this year, but it also hasn't been that great. And when you look at some of the expectations for the 3rd quarter, for the 4th quarter, is that it really picks up in the 3rd quarter. I mean, seasonally, this is generally a good quarter, but there is a significant increase in demand expectations. And the market seems to think, I mean, the market seems not so confident about that increase in demand. So all in all, I think it's a very complicated structure that OPEC Plus has with these cuts now. And they are in a difficult position now where any increase in demand may actually be met by increase in supply by producers outside of the OPEC Plus group. So there seems to be very little room for them to increase supply in the rest of this year. So what I expect is that they just extend all the output cuts they have to the end of this year, ease that market anxiety, and the 2025 outlook will still count on demand being strong, which is not really a given.
So, Salih, I guess when we talk about demand, one of the wild cards I always think about is China. What's the market discounting today in terms of demand from China?
Yeah, that's a big question mark. And, you know, as you say, China growth has been one of the biggest drivers of oil demand growth as well. And I think we could be looking at a change in paradigm where, you know, I think the market may have been assuming a 6% growth for China, where maybe we need to be pricing in a 4% growth in China. And it's still unclear what that would mean exactly for how that would translate into oil demand growth numbers from China. But I think a lot of the anxiety we're seeing right now for expectations of oil demand in the second half of the year is still being driven by China, because we still don't know where China goes from here in the third quarter and fourth quarter.
And that's sort of the problem. Like, nobody knows where demand is going to go. Like, it's going to eventually decrease, but it's not going to zero. And it feels like, as you were just saying, therein lies OPEC Plus's problem. At the same time, the supply side here in the U.S. and Canada, Brazil, Guyana, it's really, really holding up. And all this M&A in the U.S. is only going to make these guys even more efficient, aka get more oil out of rocks, for example. What do we make of that part of the equation?
No, I totally agree with you. And I think the dilemma for OPEC Plus right now is clearly their strategy has been focusing on supporting prices and foregoing market share for now, because, they need higher oil prices to fiscally break even back home. But the dilemma is that the higher they keep prices for their transformation projects back home, or whatever it might be, for the fiscal break-even prices, but at the same time, the higher they keep prices, the more they encourage non-OPEC Plus. I mean, as you said, the US shale, Brazil, Guyana, pretty soon Namibia. So they're at this point where, they want higher oil prices, but the higher they artificially keep oil prices, the more they're encouraging non-OPEC Plus supply, which in turn makes it very difficult for them to start tapering those cuts. So it's a very difficult position for them, I think. And very briefly on your point on demand, again, I absolutely agree. As long as I've been covering the oil space, I've never seen a bigger divergence in oil demand expectations between different agencies. When you look at OPEC Plus, what they tell us for this year is that they expect the growth in oil demand globally to be 2.2 million barrels per day. What IEA is telling us is about half of that. And, when we talk about 2030, 2035, it's pretty common that we see divergence in expectations between OPEC and IEA. But for this year, to have such a big divergence is something that I've never seen before. So clearly, no one really knows what happens in the second half of the year. As I said, third quarter, an uptick is likely. This is a seasonally good period for oil demand. But then what happens in China and what happens in the fourth quarter globally, we really don't know.
See, I told you, Paul. I told Paul, I was like, look, you don't have to know anything about oil right now because no one knows what's happening with oil. So you're good. You're in good company.
So, Salih, how about supply from our good friends in Texas and Oklahoma? Where's the U.S. in terms of global supply these days? How does the market discount that?
So, as we've discussed on this call before as well, last year, I think the U.S. supply growth surprised all of us. Many of the analysts on the street, including myself, we didn't really see that growth from the US coming, because we've been talking about how a lot of these producers, a lot of these companies are very much prioritizing shareholder returns. CapEx levels are not expected to be at pre-pandemic levels just yet. And even with those, we saw incredible growth in US output. This year, what we're hearing and what we expect in BI is probably not as much growth as we saw last year. But again, oil price levels have been very favorable for these producers. So they've been able to deliver those shareholder returns, but at the same time, increase CapEx that's going into their current projects, as well as some of their growth projects as well. So I can't give you a number, but a number that's probably slightly lower than the number we saw last year, which was about 1 million barrels per day. Which again, it may not be as big as the number last year, but I think it's still a big enough number to give OPEC Plus trouble.
All right. Salih, thank you very much. Salih Yilmaz, we really appreciate it. Bloomberg Intelligence Senior Technology Analyst joining from Dubai. It is very much a confusing market for sure.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's switch gears here and talk about supply chains. Again, I think we all became somewhat expert in supply chain analysis during the pandemic because, boy, did that take a big shock? And the question is kind of where are we now in a post-pandemic world? Oscar de Bach joins us. He's the CEO of DHL Supply Chain. He's joining us remotely from our Amsterdam bureau. I haven't even been to our Amsterdam bureau, but I'm sure it's spectacular like every other bureau we have. Oscar, thanks so much for joining us here. I'd love to get your perspective as you think about the global supply chain from your perspective. Where are we in terms of getting back to, I'm going to say, normal? I'm not sure if that's the right word, but where are we in terms of moving goods around the world?
Yeah, no, really good to be here, and indeed the view of your Amsterdam studio is really good. Actually, it's not Puglia, but still it's decent. So back to your question. Yeah, what is normal is obviously the question. But what you do see is if you take the last 4 years, where we've seen obviously every distraction and disruption of supply chains over time, being it wars and being as obviously the disease and all of that. But where I think we are now is starting to get in a phase where it gradually starts to stabilize. But it's also because companies have become far better, and people as well, obviously consumers as well, but the companies have become far better to respond to the unexpected. And I think that's also one of the elements on how supply chains are now managed far better than at the time. Sort of companies moved away from the just-in-time part to now making sure that products are actually available. There's far more security in supply chains, but also there's better use of data. There's better, so the whole digitalization is better. Yeah. And indeed, supply chains are organized differently. If you look at where stocks are being put, how it's being spread over the world, whether you now call it nearshoring, omnishoring, China plus one, all of that. But you see a change of how supply chains are organized.
Well, and then to that point, I mean, I was going to go with logistics and robots, not, future crazy weird looking robots, but just the idea that companies had to become much leaner and get better and trim lots of fat and be better at logistics to do all the things that you're talking about. That's also an investment cycle. Where are we in that right now in the industry?
So what you see is that indeed the industry has really accelerated in that perspective. So if you take the robotics element of it, and indeed it's not a futuristic thing, it's actually happening today, where lots of operations, of fulfillment operations, work with collaborative robotics, where people work together with robots, with robotic solutions, and that's one way which is important not only from a productivity perspective, but also to be able to manage and to cope with fluctuations of seasonalities, of high seasons, peak seasons. And you see that if I take our own company as an example, where maybe 5 years ago we would have 0 robots, we now have about 7,000, and that is fast growing further. And that helps us to better manage the unexpected, but also better manage peak seasons, and also to make a working environment more exciting for people as well, because that's the other element. You need to make sure to be able to attract people, to be a great place to work for people. So that's another important element on that robotics agenda as well. But it always comes together with being better at data analytics, because the better you can read data, the better you can forecast, make the right investments, but also forecast what's going to happen tomorrow, next week, and the week after.
Oscar, one of the themes that came out of the pandemic was a sense of we got to shore up our supply chain. So that means, I guess, onshoring, friend-shoring, maybe bringing stuff a little bit closer to the end market. Are we actually seeing that? Do you actually see that in trade flows?
Yeah, what you see is and you already said it right? There's several names that has been given to it, whether it's now nearshoring, onshoring, omnishoring, and then you have the China plus one terminology. But what it all comes back to is that, yes, there is an element of having stock closer to the end market, but there's a more important element is that companies don't bet anymore to have their key supplies, their key components, coming from one sourcing point on one continent. They all make sure that whenever they now make investments in their next capacity, so their next production site and their next they make sure that it is on a different continent. And that's what you start to see. You see that very much in the semicon business, right, where you see lots of investments in Malaysia, investments in the US, investments in the eastern parts of Europe. So that's a trend you see. Or if you look at the automotive industry, the major investments that you see in Mexico there, but similarly also in for instance, in Thailand, in India. So you see that the supply chains are being spread moreover to actually spread the risk. And indeed, at the same time, also be closer to the market.
Before we let you go, you talked about how suppliers are looking for the not just in time, but to build a little bit of inventory, which leads me to demand. Where are the weak parts right now?
The weak parts in the supply chains, you mean?
Yeah, I mean, like in terms of the demand pull, like what kind of countries are buying? Like what kind of industries still have that demand pull?
Well, I think overall, it's not that there's. So what you see is that the demand pool overall, because I was just in a different interview, we were just discussing about the volumes that are upcoming, and what you clearly see at the moment is that stocks are being built up. Not to the levels maybe that we've seen 2 years back, but companies are building up stock because they are forecasting a certain demand pool in Q3, Q4. Now, how much that actually is going to be, that we now need to see. Your question about from a geography perspective, there's obviously we see an increased flow from Asia to the US to Europe. We see an hesitant increase of building up of stock in the US. Similar picture in some parts of Europe. So that's a bit from a geographical perspective how you see that. But overall, there is a sort of a careful building up of stock being ready for a sort of conservative peak season.
All right, Oscar, thank you so much for joining us. Really appreciate getting your first-hand insight. Oscar de Bach, he's the CEO of DHL Supply Chain, joining us from our Amsterdam bureau, which, again, for those on YouTube, looks pretty darn sweet.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business, finance, and economics through our lens of Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries around the world. And for the month of June, Bloomberg Radio is committed to bringing you segments and guests that focus on the topic of equality. And today, we're speaking with Ashley Fox, CEO and founder of Empify. Ashley, thanks for joining us in studio. You're based in Atlanta, Georgia, but you are a recovering Wall Streeter, so yes. New York is still kind of home for you.
Yes.
What is Empify?
So Empify is the word empower and modify merged together. So I made the word up.
I like it.
We are a fintech startup that is revolutionizing how adults and children learn how to build wealth. So we create financial education tools and resources that target the 99% that Wall Street often overlooks. So we created programs in school systems and prison systems. We have a membership-based app where people from all over the world have access to financial education in the palm of their hand.
So what are you trying to address initially? Is it just the fact that you're trying to say, hey, this is how you invest? Or, I mean, what's kind of, how do you get there?
So coming from a Wall Street background, we worked with ultra high net worth individuals. And so when you had at least $25 million, there's an infrastructure set up to help you protect your wealth, grow your wealth, and preserve your wealth. But what does that look like for the everyday person? Because you can't just walk into a bank and say, hey, can you teach me how to buy a stock? Can you teach me how to create a trust or build a legacy to pass down to my family? And I wanted to create something that gave that Wall Street experience, but for the everyday person. So we're teaching you the basics, getting your investment started, because there's a lot of fear, doubt, and worry. And I wanted to break that mental barrier to show people no matter how much money you do or do not have, where you come from or what you look like, you can build wealth brick by brick, share by share. And so we want to make it in a culturally relevant, easy to understand way. So we've taught middle school students how to open brokerage accounts, how to buy stocks.
This.
We've been in the prison systems teaching the everyday person a topic that we don't like to talk about at the dinner table, but it is something that can change our family's dynamics, definitely.
So I've heard a lot. My daughter will be in middle school in a year, so I love this program. I keep trying to teach her, if you spend that, you won't have that money later,
Yes.
but it doesn't always sink in when she's 9.5. In terms of people who use your app to help generate wealth, what is their income base to begin with?
So when we think, our tech platform is a wealth builders community. So you can kind of look at that like the Netflix of finance, where we have over 250 hours of classes, tools, resources, covering from retirement planning, stock investing, parent investing, legacy planning, life insurance, and giving that holistic experience. So when people come in, I would say we have working professionals 25 to one of our oldest members is 73 years old. So we typically target working professionals and entrepreneurs who have some income coming in but are financially not educated, financially scared, not sure what to do, where to go, or who to trust. And we create that safe, like community-like environment that teaches them the basics to, again, starting to open your brokerage account, understanding the different types of stocks that are out there. How do you build your strategy so that you're growing your money, not just spending it, but you're preserving it and you're properly passing it down. So it's more of a holistic experience that targets the mind and hearts of people who want to invest, who want to learn how to build, just don't know where to go.
So I'm trying to think of my kids, and I think some of the advice I've given them is max your 401k, do that, pay your credit cards, don't let anything ride on your credit cards, pay it off. I mean, some of the basics. What are some of the basics that you start with your clients?
So one of the things that we do is take inventory of where you spend your money. Where are you shopping? Yes. What do you eat? What are you wearing? What gas do you pump? What kind of car do you drive? Because chances are a lot of the companies we use, know, and believe in are publicly traded. And we think that we need a lot of money to invest, but there are a lot of stocks that are under $300. We got trillion-dollar businesses that are less than $300 a share that we give more money to. And so the easiest way for us to do it is to start with what you know. Don't go research a random company you see on the internet. Start with who you are a loyal customer to, because it's a lot easier to read financials. It's a lot easier to understand a company, and start there, because the chances are if you're giving your money to these companies, there's a lot of people who are too. And so really getting it down to who are you, what do you use, what do you need, and let's start from there. So I always tell people, if you're going to use it and give your money to the company, why not consider owning a piece of that company? And you can do that by investing in the stock market.
You told us sort of why you came up with this idea. How long has it been around? What's it been like, the whole journey?
So I left Wall Street July 2013. I haven't looked back since. One of the craziest but most fulfilling experiences. I went on to be a financial advisor targeting low to moderate income individuals because I had a bunch of security licenses. And I realized that I didn't want to focus on the implementation. I wanted to give the education. And so that's where Empify. So I came up with the word in 2013. We didn't generate our first stream of revenue until 2017. 2017, we got contracts with schools in Atlanta, Philadelphia, and in New York City. And then we went on to really massively produce education all throughout the country. COVID hit, and schools didn't know how to function. But the beauty of that was there were a lot of adults saying, I see what you're doing in school systems. What can you do? And I felt like God put me here not to just serve one individual as their advisor. I wanted to build what Kleenex is to tissues is what Empify will be for finance. And that's what I wanted to create. So in 2020, we launched our Wealth Builders Community Platform, which is the tech platform that allows adults in over 44 different countries, thousands of people, to get access to the tools and resources. It's been a journey.
So that came second,
yes,
to the educational part, to schools and prisons.
Correct. So first we were B2B, and then when COVID hit, we became B2C, but we were able to scale a lot faster because we had technology. And so I would say journey-wise, it's been fulfilling because we've impacted the lives of millions of people. We've partnered with community college, financial institutions, companies that I used to work for or research we're aligning ourselves to these organizations to be able to create financial education resources for the everyday person. So I can say as an entrepreneur, it's been a journey. I started out with something I wanted to give the world. I didn't know how. I did not know what I was going to do, but I knew why, and I knew I wanted to be the woman to get it done. And I think I'm able to translate Wall Street knowledge because I understand how the banking system, how Wall Street works. But I also didn't come from growing up with a lot of money. I'm the first person in my family to graduate from college. I was making more money than both my parents when I was early on Wall Street. And I wanted to be able to take that universal language and create something that can make people believe no matter what you look like, you can build wealth. And no matter what you do or do not know, Empify is here to give you that education.
How many employees do you have in your company, and how's that grown?
So right now we are a team of 8. We're actually in the process of hiring 3 more individuals, so we will be in double digits. I think that's been the most challenging part, the people part. They don't teach you that in school.
Like finding the right people?
Finding the right people, building the culture, having just the resources, the environment. I think everyone on our team is phenomenal because they believe in what we do. And I think I never left Wall Street to make money. I think I would have stayed there if I wanted to make the money. I really wanted to change the dynamics, because you shouldn't have to go to Wall Street to get access to this information. How can we put it in our school systems? How can we talk about it at the dinner table during holidays? And so we are right now a team of 8. I would say in the next 30 days, we'll probably be a team of 12 people. But we are growing fast as a company. It's been an exciting journey.
Amazing. This was such a great story. Thank you so much for bringing it for us. I had 0 financial education until I started working in this industry, and I had to claw my way up. So I'm so appreciative of what you guys are doing. Thank you so much. Ashley Fox, CEO and founder of Empify, on her fintech startup, help regular old people build wealth, figure stuff out. Really amazing stuff.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.